Good afternoon and welcome everyone to the Halderman Maximizing Your Profits quarterly webinar that we love to do. We've had a lot of success over the last couple of years doing these via Zoom, and I think people enjoy them. You get a quick update. We try to bring in different topics. We got a different one for you today from a little different perspective. And I think we've got some different ways that we're looking at the farm real estate market, some analysis that Pat Karst has done that I think you will enjoy as well as I get into my presentation. I'm Howard Halderman, President and CEO of the Halderman Companies, and just welcome to our Farmland Update. We are going to, after I get done, we're going to turn things over to Lucas Hill and Hannah Sampson. Lucas and Hannah are representing Modern Woodmen Fraternal Financial, and they're going to be talking about estate planning, estate and tax planning for farmers and landowners. And you might say, hey, you know what, with the current estate tax exemption, I'm not too worried about that. But with the appreciation that we've seen in farmland values, and you might be surprised by some of the numbers, or maybe not surprised, but some of the numbers that I'm going to show here in a second, your farmland assets are worth more than they've ever been. And so it isn't so much about today that you're worried about estate planning for, but it's 2026. And I think, as Lucas can probably tell you here in a few minutes, that number that's exempted, it goes down dramatically in 2026 unless Congress changes something. And I wouldn't bet on one way or the other there. So I think some planning prior to that time period is where we're going with this. So as we get into the presentations today, I would encourage you to put any of your questions in the chat. Joe Halderman's going to be monitoring that, and he's going to be able to let me know if we've got folks that have questions, and we'll try to get those answered as quickly as possible. You're going to remain on mute, so that you need to communicate with us via the chat. The other thing I do want to mention, we are recording today's session, and the recording will be available for anybody that wants it, and you can communicate with us via email at the end if you wish. And likewise, our slides, both mine and Modern Woodmen, those slides will be available if you would like those to share as well. So with that, I'm going to jump into my presentation on farmland values and kick things off today. Joe, can you see my screen just fine?
Yep, we're good to go.
All right, thank you. Well, as you read on the first slide, farmland real estate trends in 2023, up or down. If you are watching equities, if you're watching the bond market, other things, maybe that down has a little different connotation than it does in the farmland space. But when you've gone through a time period like we have, where farmland values have appreciated quite rapidly over the last 2 years, it's a fair question, and we'll get into that. And as I said, farmland values have been strengthening. And Joe, tell me if my slides are moving for everybody. Is it slide 2?
Yep, we're on slide 2.
So the farm real estate market, and we've talked about this before in previous sessions, so let me just bear with me if you've seen these things. But there are reasons why people sell, right? And if you think about any asset market, sometimes there's macro trends, macro drivers that cause people to say, hey, I want to liquidate that asset. And really, in farmland, there haven't been outside drivers. Certainly, in the fall of 21 and the fall of 22, we saw increased supply of farms on the market, but not really an outside driver like a tax law change or a state tax change or USDA farm program change, nothing like that. So really the market was pretty thinly traded from 2014 through 2020. Honestly, through mid-21, and it wasn't except for the fall of 21 and the fall last year that we saw increased supply. I looked at the farm papers just today, and when you look at what's available, what's out there right now, it's a thinly traded market. That's supportive of farmland values. So as I said, the number of sales improved in the fall and the winter of 21 and also 22. What we saw last fall, I would say, was just more typical. It wasn't an overabundance of supply, but it was certainly more common. And really the question mark is, we're thin through the first quarter, kind of normal numbers for the first quarter, but where does the rest of 23 go? Cropland values, because we were in a lower volume time period and farm incomes were not outstanding, from 2016 through 2021. Cropland values were pretty stable during that time period. But now we're at the all-time high. The last 3 days, I was at the Global Ag Investing Conference in New York City. And that it was 750 people from around the world who have an interest in investing in farmland. And they come to New York every year to learn how to do it, who they might want to partner with, et cetera. And the guy that kicked off the whole event on Monday morning, one of the things he pointed out is for years, and Global Ag Investing has been going on for 15 years. And he said, I've come to this conference for 15 years, and we always talk about farmland being a hedge against inflation. And up until the last 18 months to 2 years, okay, I understand that, but it's not meaningful. And then over the last 18 months, you've seen that it is, in fact, a hedge against inflation. Because when you get into higher inflationary times, what did farmland do? It appreciated very rapidly. Not solely due to inflation, but certainly that was a contributory factor. And recreational timber and rural residential values all increased. We had higher incomes, we have better employment. When the general economy does well, all types of real estate tend to do well. And you have this little thing called COVID that caused some folks to maybe be able to work from home, be able to work from wherever. And they wanted to have a piece of rural real estate to enjoy. So here's the USDA cropland values. The thing I will point out here is that obviously these numbers are probably not representative of the Eastern Corn Belt, first of all. This is an average across the entire United States, cropland values. And so 4,400 is where we were at the end of 22 or 21. That appreciation was only 7 or 8% last year, right? If you look at those numbers. That is not what we've experienced here in the Corn Belt. What that tells you is there are other parts of the country that haven't experienced the appreciation we've seen in the Corn Belt. And the difference is really our commodities. Corn, soybeans, and wheat have seen quite a bit of commodity price pressure upward and farm incomes going upward as a result. Where you've seen the drag is in other areas, more permanent plantings. And when I mean permanent plantings, these are tree nuts, these are tree fruit. There are areas around the country that haven't seen quite the appreciation. But this really shows you that stable time period I referenced earlier from 2014 through 2021, and then we're starting to see the increase. Now let's get a little more localized, because really most of the folks on this call are interested in what's happening here in Indiana, Ohio, Michigan, and the surrounding states. So the Federal Reserve Bank of Chicago, they have ag lenders contributing to a survey every quarter. This is the most recent survey results. We'll see some more results here in a couple of weeks for the first quarter of this year. But this really shows you that the percent change in Indiana from January of last year to January of 23 was 23%. That's a big, significant increase. That's on top of a 20% increase the previous year. The other thing to note on this is that's not consistent across all of the district. In fact, the district was only up 12%. That's the black bar on the far right. So it wasn't representative of all states. Indiana just outperformed in that total year. Notice the fourth quarter, though. The fourth quarter showed very little change. And that you'll see in our slides and our information as we get more specific. Here's the Purdue Farmland Survey. You probably have seen this in previous presentations because this data is June generated. So we're going to submit our opinions here in a couple of months. And it shows the hockey stick move up that Indiana, this is Indiana specific farmland values have experienced. You know, that top best quality land is at $12,750 an acre. I've commented in most of our winter seminars this year. Many of you wouldn't even consider selling your farm for $12,750 today. Again, this is lagging a little bit. I would expect this number to be up pretty significantly when these numbers are done here in June. Summary of our sales. So this gets down to really specific transactions that we've done. Those previous slides were surveys. These are actual sales data that Pat Cars tracks for us. Couple of comments on this slide. If you look at the red line, that's the trend line. We are taking the sale price and dividing it by the weighted average productivity index of the soils on that farm. That's the WAPI. We've talked about this before for those of you who've joined in the past. That productivity index, we can measure and map every field, every cropland field in Indiana, and come up with that average productivity index. We divide the sale price by that, and you end up with so many dollars per corn bushel of productivity index. So as you look at this, you say, well, gosh, Howard, 2022 was pretty flat. And it was. Our sales would suggest that somewhere in that $85 to $90 per corn bushel was the average. You might note as you look at the Q3 results, and the time is down at the bottom on the x-axis. Q3 results were pretty narrow, a narrow band. And then as we got into Q4, two things to note in Q4. Volume increased a lot, and as mentioned that earlier, and that's the width at the bottom x-axis, but also the volatility. Look at the highs and the lows. We saw higher highs or not so much higher highs, but same high numbers, but lower lows. So we saw more volatility in the sales data that we were seeing. I was asked at the Top Farmer Workshop that Purdue put on back in the first week of January, what's the difference that we experienced throughout the year and what do we think for 23? And that volatility is really the thing that I wanted to share with folks is I think you're going to see more volatility. And in a couple of slides, I'll really put some evidence to it with specific sales. Now, here's the 23 data. 23, you see the trend line going from 80 up to 105. This isn't a huge volume of sales yet. So I wouldn't call this trend and I wouldn't take this to the bank, so to speak. But it surely shows that 23 is still experiencing strength through the first 3 months and a little more than the first 3 months of this year. So no worries, is the banking crisis causing any concerns to farmland? No. Are higher interest rates impacting farmland negatively? No. That's how you would interpret this slide so far year to date. Now, this is kind of really an interesting chart. You've probably seen this before, but this shows that long, stable time period. Remember the USDA chart? It was very flat from 2016 to 21. Ours is the same, right? You see that the spread there through the 2016 to really the middle of 21. And then it went from $50 to $80 overnight. And yes, that in fact was what we experienced in our sales. And then as you note toward the end, 2022 and 2023, a little more volatility, but also a trend upward. So still positive indications. So one of the things I asked Pat and we discussed over the last couple of weeks was, well, all right, let's look at this data and does quality matter? So let's look at the data, and this is a little different way to look at it. The bottom, the x-axis is the WAPI score. So on the left is 111 bushels of corn to the acre, soil productivity index. That is below average farmland. That is really sandy stuff. That's really drought prone, flood prone, problematic soils. On the far right, it's 173 bushels to the acre. In reality, that's going to produce 225 bushel corn year in and year out. Those are the top quality soils in the state. So one would probably think naturally the better farms should sell for more money, and they do. But then we divide that out per corn bushel, and does that change? And so our data would suggest from 21, 22, 23 sales that yes, in fact, better farms sell for a higher dollar amount per corn bushel of productivity index. I don't think that's surprising news to anybody. That just kind of confirms what I would normally believe and puts it in a documented actual sale fashion. Does size of the parcel matter? So this is another chart. This is impossible for you to read. It's really about the trend, and it's because we've got a lot of data from 21 through 23 here. But basically, small size farms are on the far left, 27 acres, all the way to far right, which is, gosh, I can't even read it, 600 acres. So what that tells you, and you might again assume this to be the case, smaller tracts sell for more dollars per acre or a higher WAPI score per bushel. And in fact, this evidence is that. Now, are they huge amounts of change? No, they're not. But it does kind of confirm what I would believe and expect. So here's a case study. And I like to point this out because many of you own farms, and you probably wonder about, does reputation matter? Does location matter? Does how I take care of my farm matter? And it does. So on November 29th, we sold 2 farms on the same day. And I apologize that Delaware County sale doesn't have November 29th, but those were both on the same day. The Cass County sale was an online only auction during the day. The Delaware County sale was online and live in the evening. Look at the WAPI score on these. Just based on WAPI score, you would say, well, that Cass County farm should sell for more money because it's got better soils. And, it's fair. It does have better soils. What I will tell you is that Cass County farm was up in the northeastern corner of the county. 12 Mile would be the address. Historically speaking, location of this isn't the best part of Cass County. I'm not being negative about that part of the county. It's just reality that farmland values have not always been as high as other parts of the county, south of Logansport. Delaware County is down by Muncie. And this farm was known as the best farm in Delaware County. Reputation, right? So when you think about location or reputation, here are two sales on the same day, very similar productivity indexes, and one sells for double the other. Does location matter? Yes. Values in real estate is location, location, location. Does reputation and how you take care of your farm matter? Yes, it does. So this was just kind of an interesting two sales on the same day for dramatically different results because of those factors. Now, here are our sales late December into January. All I want to point out with these real quickly is the volatility that I spoke of earlier. You've got a Tippecanoe County at $102 per productivity index bushel, and two sales later in Hancock County, east of Indianapolis, $65. Next slide. You've got 158 at the top. Granted, that's irrigated, so that's probably skewed because of the soil types of irrigation. But right on the same slide, you've got a 57 and you've got a 67. So again, volatility and more variability that we're seeing in these land values. As we go onto the February, March slide, you've got some hundreds, and at the same time, you've got a 73. That makes the average. Our average is 85. But it's pretty variable. And then we get into more sales here that we've had here in March. And gosh, there's a Rush County at $19,000 an acre. It's $116. And two sales later in Miami and Fulton County, it's $52. So a lot of variability today. And that's where I would point out that talking to your area representative, your alderman representative in your area, can be extremely beneficial to help you know what the right value is for your property. And then here are the two sales this week. One brings $21,000 in Henry County and the Pulaski County at $6,500. Is that quality? Yes. Is it location? Yes. Those are factors and dramatically different results. You can follow our sales on our app. So who are the buyers? I've updated this slide. Pat updated this data for me just over this last couple of days. 2022 ended up predominantly farmers, but just by 4 points. 2023, 65% of our buyers are farmers, a little less investor influence. I asked all of our staff as of March 1st, who are the major buyers? 84% farmer, 16% farmland investor. So all sales, this is our sale data. This is all sales in a marketplace, and it's still heavily weighted to the farmer. Not a surprise at these high land values. The farmer is the one that wants to own that land next to them. We've talked about the ag barometer in the past. This is the survey that Purdue University and the CME group do. And they ask producers how they feel about agriculture. Do they want to invest more in agricultural equipment, land? What do they think about the future? You can see the results that came out earlier this week were down again, 117. That's still above an average feeling of 100, but it's pretty low compared to where we're experiencing all-time high farmland values. Why? The banking crisis is a concern for people. High input costs and the future outlook for lower commodity prices. So narrower margins this year are a concern, and then higher interest rates. So I think those things are factoring into this negative feeling, but it certainly isn't translating into farmland values yet. We talked about inflation being a factor. This chart just documents what was expected inflation to do to cropland, and actually we've exceeded the blue line on the top. As I said earlier, we're at all-time highs. The black line is nominal, so take inflation out of it, all-time high easily, right? Well, when you adjust for inflation, we now have gone here in late 22, early 23, above the all-time high inflation adjusted in 2013. Debt, we've talked about this before. As you think about farm debt, 50% of the debt is held by Farm Credit, 31% by commercial banks. So when you start to think about the banking crisis, if that develops more fully, honestly, ag banks and the farm credit system are in pretty good financial shape. So really not a concern in the ag industry is what I want to leave you with today. SVB, Signature Bank, they had unique lending practices. They were much different animals than most of the banks that you will find throughout the Midwest. Farm real estate debt is exceeding, inflation adjusted, exceeding the 1980 high. But structurally, I think we're in a lot better place. We have a higher percentage of real estate debt. What's typical about real estate debt? It tends to be fixed. It tends to be long-term and probably fixed at low interest rates. And so while interest rates have moved up, they're not historically high. Gosh, I had the benefit of starting in 1988. Those are high interest rates, 12, 15%, maybe. And I heard somebody comment they had debt at 19% back at that time. So 6 or 7 is higher than where we were, but it's not historically high. And a lot of that real estate debt is fixed at lower interest rates. Another way to look at it, real estate in blue, non-real estate in red. Non-real estate tends to be your operating lines, equipment. Those tend to be more variable rates in nature and go up higher. And the nice thing is structurally, we're not at a high percentage of that kind of debt. Where is the real estate debt segregated? Well, the blue is total number of farms. The orange is debt. No surprise. Most of the debt is consolidated with those producers that are producing more than $1 million worth of revenue. Interest rates increasing, they certainly have. But this is a nice chart because this goes back to 1990. And when I say it's not historically high, you don't have to just believe what I say. You can look at this chart and say, yep, we're at 7% on the far right. But historically, that's not a super high number when you go back to the 1990s and 2000s. But what does it mean? Here's the cost per bushel of corn. Or I guess this is farmers and ranchers spent 35 cents of every dollar they earned. So you earn a dollar, you spent 35 cents on interest, 35% on interest back in 1980. Today it's 12. So that also puts it in a nice perspective. Debt to equity, debt to asset ratios still remain very low, ticked up a little bit, but 15, 13%, not concerning whatsoever. Debt divided by income, $1 million of debt divided by a $250,000 farm income, that's a 4-to-1 ratio. We're at 3-to-1 today. This becomes concerning when it goes above 5.5. We're not close to that. So I want to leave you thinking about debt as we're in a pretty solid financial perspective when you think about farm real estate debt. Delinquencies are very low, should be that way since we came off a record income year last year. So we're not projecting a big concern if we get into lower farm incomes near term. So where do values go from here? Really, it's farm incomes, interest rates, and supply. Those are the drivers. We've talked about that for years. And you can say, well, Howard, what's changed? Farm incomes, we had a record year last year, all-time record incomes, inflation adjusted. You really got to go back to 1973 to find a comparable year. So that's bullish. Interest rates are bearish. While not historically high, they are up. Supply of farms for sale, we had quite a bit back in the fall, but not so much now. So I put that as a neutral. So we talked a little bit about incomes from 07 to 13 being, we had tons of income generated during that time period, kind of the golden area. We had a cash drain from 14 to 19. Government support became pretty critical in 18 and 20 to keep working capital supported. Interest rates are increasing rapidly and the farms for sale less than 2%. So here's this farm income chart. Now you'd say, well, Howard, you just said it was an all-time high last year. Well, look at the far right. That's projected 23. So you look at the second to the far right, and that's your record income last year. Again, got to go back to 73 to find a similar income year. We're projecting lower incomes this year, but look at where they are comparatively historically, just really back into that golden era time frame. So while incomes are projected to be down, not in a hugely negative way, I don't think. When you hear about net farm income, look at this. There, go back to that slide real quick. 136 billion. And what this gray line says on the far right is at 115 billion or above, it's a positive year. That's the way you would read this slide. For decades, couple decades, 73 to 2005, the benchmark was kind of 85 billion. If we were above 85 billion, it was a good year. Below, it was concerning. Now I would argue that's moved to 115, and we're above that again projected for next year. Cash rents tend to lag incomes. I would expect in the farm survey, the Purdue survey that they do this summer, we will see that rents went up faster percentage-wise than what farmland values did in 2022 to 2023. And that's really what this chart suggests, is when farm incomes go up, cash rents tend to lag, and they go up not quite the percentage that farm incomes do, but they do start to increase over time, and I would expect that to continue. Impacts of renewable diesel. There's a lot of folks talking about SAF, sustainable aviation fuel. That whole airline industry is not going to go to batteries. You're not going to fly planes with batteries in them. You're going to fly them with some kind of fuel, and renewable diesel seems to be getting some traction. That's a positive. It's been positive for soybean oil up until the last couple of weeks. I would expect that to be a good demand driver. China remains a good trade partner. I shouldn't say they're a good partner. They buy a lot of our stuff, right? And agricultural is in a good spot there. 22 actually exceeded 21 in terms of trade with them on an agricultural basis. They're not a great partner otherwise. Leave it there. Impact to timber values, still positive. Here's the farm cap rate. Just a minute on this. We're at 2.25 today. So that's net cash return to farms. This is two things that this means. One, I think this increases because I think I said just a minute ago, rents go up faster than land values. So this probably moves back up toward 2.5, 2.75. But what are CDs today? If you're looking at putting your investment someplace, what are treasuries? What are CDs? They're at 4. So farmland's not going to generate that kind of cash. I was just at an ag investing conference, and that is something that these large institutional investors do consider. What are my alternative investments in the fixed income space? And right now, farmland's at a negative position. For years, it was in a positive position. I asked our staff about 23 rents, and I'm going to hit this real quick. The expectation was we expected rents to go up. You're coming off a record income year. They probably go up, right? Anywhere $7 to $75 an acre. This was a March 1st survey that I did. Did they increase rents? 15 said yes, 15 no. Keep in mind, we do a lot of cash flex leasing at Halderman. So the cash flex lease tends to have a big bonus if it's a good year. And we had a lot of large bonuses at the end of last year because it was a good year last year. Demand, yes, there wasn't anything for rent, and there was demand, more demand for land to rent than what we've been experiencing. That stands to reason because we're coming off a good farm income year. Many of you know we do cash flex leasing and base gross revenues. This is the baseline, that the dollar amount that the farmer receives before they start splitting profit with the landowner. These are at all-time high levels. $750 kind of middle of the range, $1,050 for corn. That's the highest I've ever seen. We've been doing cash flex leasing since 1997. So that's a long track record and as high as I've ever seen it. Soybeans upwards of almost 800 plus. So those numbers went up, but still paid some pretty good bonuses. And then here's the Purdue Cash Rent Survey. You might remember the real estate survey showed a big hockey stick move up. This shows a move up, but not quite as dramatic. Again, I expect this to move up faster this year than what land values did. So as we talk about and wrap this up, our forecast, you got long-term world demand fundamentals. We see this, any kind of hiccup with Ukraine shipments of what Russia allows, corn, wheat prices respond. Any kind of production problems in Argentina, corn and soybean prices respond. So that just in time, the demand for food is there. Interest rates are certainly higher. They're becoming a little bit of a challenge. Not too many years ago, like 2 years ago, we were at 2.77% fixed for 15 years, and now we're at 6.8. That's a material change. Supply of farms picked up last fall, kind of remain near normal, not as much right now, which as we get into the planting season is pretty normal. Government support, I would say in 23 is likely very low. As we look at the Farm Bill going forward, I think you're going to see similar programs to ARC and PLC continued, but I wouldn't anticipate a lot of government support. What you really want to do is encourage your representatives in Congress to maintain their support of crop insurance. And input costs and inflation are certainly higher. Break-evens are higher. So where does break-even come into a factor? $5 corn, right? If we get back to $5 corn, which some people are projecting, that's below cost of production, believe it or not. So that's where this higher input costs and that higher break even become concerning if we get down toward $5 corn. $11 soybeans. So cropland values are in an uptrend. We foresee that continuing. We just don't expect it to be as dramatic as 21 or 22, probably 0 to 5%. Those other markets are really going to reflect the general economy and the housing market. And so if housing's weaker, that steady to weaker probably exists in those other land classifications. And then I mentioned more volatility. I've said that a couple of times. Those average to below average farms, those are the ones that you really got to watch. They're going to sell at the lower end of the range, that's $60 per corn bushel of productivity index, versus the really premium farms, which are going to bring the 100. So I'm bullish, for all these reasons that you see on this slide. Profitable prices, a lot of cash and liquidity coming out of last year, low amount of debt to assets in agriculture, moderate supply of farms for sale. You got biofuels, the RFS got renewed, SAF fuels coming online. So all those reasons are really positive for land values, and that's probably a bigger weighting there than the negative. And the negative, much of the same that we've talked about before, but I think as we go into fall with higher interest rates, if we see a reduction of commodity prices to below break even, if you put that on top of the higher interest rates, certainly I think with what the Purdue barometer was showing, one could say farmland values could take a little bit of a dip. We're not there today. We're at profitable prices today. Interest rates are up, but probably flatter now. So today I expect farmland 0 to 5% up this year. Just if you want to look at headwinds, that would be where to watch is the commodity prices. We talked about competitive other investments. I'm not suggesting the stock market's competitive with farmland. It's not. I mean, people don't invest in the stock market or farmland. Those are two different types of investments. It's really the fixed incomes, the liquid treasuries and CDs at 4% plus. That's where if people are concerned about the future in ag, maybe they put their money that way. So as I said there at the bottom bullet point, we expect the market to move up 0 to 5%. And then this is what my staff told me. Higher 4, lower 3, and the same 16, and that's kind of where we ended up the year, or the March report, with a little weaker feeling about rural residential lots and recreational land. So with that, Joe, I assume we have some questions.
I do not have any right now.
Okay, so they're just looking to get in. All right, so if you have questions, enter them into the chat. And with that, without any further ado, I'm going to turn it over to Lucas Hill. Lucas is the regional director for Modern Woodmen Fraternal Financial, as well as Hannah Sampson. She's a financial representative with Modern Woodmen. I'm going to turn it over to Lucas and let him, I need to stop sharing mine so he can share his, and I'll let him take it away to talk about estate and tax planning for farmers and landowners. Lucas, it's all yours.
Okay, very good. Thank you for the introduction. It's an honor to be here. Thanks so much for having us. I will share my screen here, and you, same thing, let me know if we can see it all, okay? Can we see it full screen now? Is that okay?
We can see you, Lucas. Thank you.
Looks good.
Okay, excellent. Excellent. Again, thanks for the introduction. I'm Lucas Hill, certified financial planner, and Hannah Sampson on the call as well. She's one of our associate financial representatives. We run a financial planning firm together where we mainly work with landowners, business owners, and farmers. We have 2 physical offices. We're in Indianapolis, Indiana, and then also have a location up in Valparaiso. But like this, most of the work we do is virtually these days with folks all around the country. We exist mostly in small towns around the country, and just help folks with their investment planning, tax planning. And right now, super appropriate to talk about estate taxes. And if folks are considering selling land or buying land or continuing to rent their land, what do we do with the income? How does it affect our taxation? How does it affect our potential retirement? So that's what we're here to speak on pretty briefly, and then we'll just open it up for some questions. So feel free to add them in the chat as we go. And here we go. So a little bit about our firm, some of our background. Our firm was founded back in the 1800s, actually, in a logging community in Iowa, and so that's how we get our funny name. We were created to take care of widows and orphans who actually lost the men in logging accidents, be sure that they were financially stable throughout their lives. I mentioned that we primarily work with business owners and farmers all across the country, and mostly investment insurance and estate planning. We do manage over $22 billion in assets. And very uniquely to the investment world, the financial world, we're actually a not-for-profit organization, the largest that's open to the general public in our space. And so we actually donate all of our profits back to the local communities that our advisors around the country operate in. And we're super financially secure. One of the most stable financial firms in the country. We have 117% solvency ratio. The average of the top 25 largest firms that you would have all heard of is about $1.06, whereas we have $1.17 on hand for every dollar of liability. So that's mostly because of our not-for-profit status, which allows us to do things fairly uniquely. So here we go. Considerations before and after selling your land. So essentially what we're going to do today for a few minutes is compare the general philosophy. Now, my screen doesn't want to work, to the optimal strategy on the following three pieces. So how to optimally invest in I think it's fair to say, relatively uncertain market environment right now. How to take withdrawals appropriately to generate income without that income affecting our future Social Security payments, without that income affecting how much we have to pay for Medicare one day, without throwing ourselves up into a higher tax bracket. Can we generate income in a very tax efficient way? And then when we're talking about taxes and we're visiting with landowners, naturally the estate planning conversation is going to come up. And so we'll spend a little bit of time on there. And I got to be fairly general here. So we'll be fairly general for 10 or 15 minutes. And then if anybody wanted the opportunity to visit individually, you just connect with us and we'll have our contact info at the end. So we'll start with the investing side. So we're going to talk about growing our money, using our money, and then leaving our money. So growing our money. Generally, the general risk tolerance philosophy is that the older you get, the less risky you should be. That has been proven time and time again to not be the optimal risk tolerance philosophy. And I'll share why in just a moment. So bear with me right here. The first 5 years prior to retiring and the first 5 years of retiring actually should be the least aggressively invested years of your life. Okay, because we need to remove this thing called sequence of return risk from the table. And as we age through retirement, it becomes acceptable and in fact prudent to become more aggressive. So we want to think of this inverted bell curve right here where, you know, from 50 to 65, 50 to 70 is going to be the least aggressively invested time of our life. More prudent to be aggressive before that and actually also aggressive at the end. The concept is because if we lose money on our investments at the beginning of when we take withdrawals from our investments for the first time, it can have effects that last the rest of our life that can be impossible to recover from. Okay, so we're going to look at a couple pieces here. I've got all these numbers on the screen, and I'm illustrating somebody who has $1 million and they're beginning to start using their money. They're going to start taking some withdrawals. And we're going to illustrate a 4% withdrawal. So that'd be $40,000 a year, indexed for inflation. And the actual stock market returns, the S&P 500, for a 15-year stretch from the year 2000 to 2014, these are the actual returns, are illustrated right here. Over those 15 years, we had a 4.07% rate of return. So if somebody had $1 million in the market, they averaged 4% rate of return, they took a 4% rate of withdrawal, we would assume that they still have about $1 million left over at the end, right? Same rate of return, same rate of withdrawal. What happens is it's actually not even close. This person's almost out of money. They're down to $273,000, even though they took a 4% withdrawal and had a 4% return. And that has everything to do with not the average rate of return, but the sequence of their returns. And it illustrates why we need to be very conservative when we're approaching our retirement and when we're in the first 5 to 10 years of our retirement, because we cannot afford to lose money at that point in our life. We can afford to lose money earlier on when we're younger and we have plenty of time to go. And we can afford to lose money when we're significantly older because, to be honest, we don't have that much more time to go. We can't afford to lose money right in the middle. So it's the fact that this person lost 3 years in a row at the outset, kind of dug themselves a hole that they can't get out of when they take withdrawals. So we're going to compare that to swapping 3 years of returns, and that's all. We take these top 3 years of returns, 2000, 2001, 2002. We remember that, right? The dot-com bubble. Y2K was scaring everybody, and terrorist attacks and all sorts of things that drove our market down. We take those 3 years worth of returns and we put them at the end. And we take the 3 positive years, 12, 13, 14, and move them up to the top. Everything else is identical. We still average a 4% rate of return, yet this person ends with almost the same amount of money that they started with. Just swapping negative returns at the beginning for positive ones illustrates why it's so critical that we de-risk when we're entering what we would call the distribution phase, when it's time to start actually using our money that we worked so hard for, that we've saved up our entire life. When it's time to use our money, we cannot afford to be in risky asset classes at the outset. So we've figured out how to appropriately grow our money, and that's being conservative at the beginning, and we can actually bear more risk at the end. But how do we now effectively draw our income? Well, there's been many surveys done of folks 60 plus, and the actually number one fear in life, bigger fear than dying, is the fear of running out of money later on in life. So the majority of the discussions that we have with folks is how do we generate enough retirement income without affecting the rather favorable taxation that our Social Security checks have right now. Because we only have 3 tax brackets on our Social Security income, which for a lot of folks on this call will be a large majority of their incomes, right? The average Social Security check is around just under $2,000 per person. So a married couple very easily could be earning $50,000 a year on their Social Security checks. Well, there's only 3 tax brackets on our Social Security checks. Very few people are aware of this, and it's maybe the most important consideration to make when we figure out, well, yeah, we need a certain amount of income, but we don't want it to affect negatively our Social Security and maybe our Medicare one day too. We only have 3 tax brackets. Think about this: 0%, 50%, and 85%. Okay, these are called provisional income brackets. Now, when we think of our typical income tax brackets, we have 10%, 12%, 22, 24, goes up into the 30s. But Social Security is only 3, 0, 50, or 85. So everybody on this call is either going to have 0% of their Social Security checks taxed, 50% of their Social Security checks taxed, or 85% counting as income tax. Okay, so the 85 doesn't mean we actually lose 85% of it, but it means that 85% of it would count as income. And so we have to be really careful when we're considering, well, what are the sources of income that we have, right? If we choose to, if we're evaluating our options and we own land and we're renting it out, well, naturally, rental income is going to count as income taxes, and every dollar of rental income will count towards these tax brackets. So it could be that, well, if we had this taxable income or we had the same amount of tax-free income elsewhere, that our Social Security check could either be tax-free or have 85% of it taxed, which can make a tremendous difference. So how do we generate tax-efficient, guaranteed income for life? Okay, and this isn't for everybody. This is to each their own, but it's a really important determining factor when we're selling non-qualified assets like land or farms. So here is an option. Folks are used to accumulating income their entire life, right? Every month we can snap our finger, we get our paycheck at the beginning of the month. Well, some folks get to retirement and they decide to create their own pension. They take a lump sum of money that they have, maybe they sold their house, sold their farm, and they exchange it for an income stream. That would be called an immediate income annuity, where folks are basically creating their own pension that lasts guaranteed for the rest of their life and for the duration of their spouse's life. No matter how long folks live, they can be to 100 years old and they have a guaranteed payout, just like a pension operates. Now, the unique thing about pensions, about annuities, I should say, not typical pensions, but annuities like this, a 65-year-old male, for example, will get a guaranteed 7% income payout for the rest of their life. Okay, so this is a guaranteed 7% income draw. But this is the important piece, is that the large majority of the income is exempt from income taxes, so long as we're dealing with a non-qualified asset like land or a farm that was sold. So if we have money in the bank, if we annuitize that and create our own income stream, about 2/3 of it every month when we get our check, about 2/3 of it doesn't even count as income tax. Okay, about 1/3 of it will count as income tax. The Internal Revenue Service loves to keep us on our toes with their unique rules, and that's one of them. Non-qualified annuities are super favorable. We only have to pay income taxes on a third, essentially a third of the income that we receive. Whereas if we had that same amount of income coming in from a rental property or from renting land or we have capital gains tax on other assets, or just we're working a part-time job, one of the most favorable income streams that we can have while also being guaranteed for life is an immediate income annuity. Now, that's not for everybody, and that certainly isn't for every dollar of somebody's assets. We don't want to annuitize every dollar that somebody has to their name, but we do want to generate enough income so that folks have complete certainty that they're going to be able to live the rest of their life without the chance of running out of money. So we want to be sure we have enough income to pay all the guaranteed expenses, our property taxes, our mortgage, any of our debt, our basic living expenses. We want to have enough of that from our Social Security and from our annuities. And then the rest we can maintain and invest in some various different ways, like Howard had mentioned. So none of the tax-free part affects our Social Security, and none of it will affect having to pay higher premiums for Medicare. So we kind of have these hidden layers of taxes in it's not just we get rental income and so we run that through our tax brackets when we pay 22% federal taxes. Well, we might have that plus now half of our Social Security check gets taxed. Oh, plus we have to pay twice as much for our Medicare premiums. All of a sudden the tax is worth a lot more than whatever the tax bracket said. So then another idea, and Howard had alluded to this, is, well, what if we don't want to annuitize and create an income stream that's completely guaranteed, but we still want to be tax favorable? Well, we can look at a portion of our investments being in tax-free municipal bond. Tax-free municipal bonds are going to pay a regularly allocated stream of income, while not completely guaranteed, though, and that's important to mention. But interest that's paid from municipal bonds counts completely income tax-free. Whereas if we have corporate bonds or any other dividends that are paid from stocks, those are all going to count towards our taxable income, dividend income, capital gain income from mutual funds. All that counts as taxes, which all affects our Social Security and Medicare. But tax-free municipal bond income, while nobody knows exactly where interest rates are going to go, but certainly we were not expecting interest rates to continue to increase at the pace that they have thus far. Nobody knows if they're going to be higher a year from now or lower a year from now, and it's not really worth trying to guess because nobody does know. But it's more about, can we structure ourselves appropriately so that no matter where the market goes, we're comfortable with the outcome. And then I want to talk about estate planning briefly, and this is something it feels like it's always been a hot button topic, but Howard mentioned 2026 coming down, before we know it, right? We're 3 years from it now, and right now, no real reason to be super concerned. If we were to die today, we have an estate tax exemption of about almost 13 million per person now, right? That was doubled back in 2018 with the Trump tax cuts from 6 million up to 12, and inflation has indexed it close to 13 million. But let's think about where historically the estate tax exemption was, because it's important to recognize the only exemption that matters is the one that's in place when you die. Okay, and so if we're only doing our planning based on where estate taxes are today, it might cause a lot of headaches and it'd be very expensive 10, 15, 20, 30 years from now when the estate tax world could look very different. So let's consider that it was just 2006 when the estate exemption was only $1 million per person. Okay, so 2006, 17 years ago, the estate tax exemption was 1/12 of what it is right now. In 2017, it was $5 million. In January 1st of 2026, Howard alluded to this, unless Congress steps in and changes things, and obviously that remains to be seen, we're set to sunset back to the $5.5 million exemption per person in 2026, which means as a married couple, that would be about $11 or $12 million total. So it's going to get cut in half. All right, it's going to get cut in half at the beginning of 2026 as it stands now. But with where our national debt is, $31 trillion today, by the way, we have to really ponder, is it realistic for our government to continue raising the exemption, which means they get less taxes? Or is it more realistic to envision them lowering the exemption, possibly even below where they're going to get cut automatically in 2026? it's super realistic to envision that income tax rates are higher, estate tax exemptions are lower, and can just be a bad recipe for folks. So there are things you can do today to actually lock in your exemption. If we shift assets into trusts or we gift assets appropriately, we can lock in our $13 million per person exemption today. So even if we die later, when the state exemption might only be down to $1 million, that we used our 13 million while we were alive. Okay, so that's a conversation for another day, but it's worth knowing that those opportunities exist. And we have to take advantage of annual gifting exemptions. So each person can gift $17,000 a year to a beneficiary, to their children. So a married couple can give $34,000 every single year to their children without any of that money counting towards the lifetime estate tax exemption. So folks that are going to have estates valued over $1 million when they pass away, really important that today we start using our gift tax exemptions. If a married couple has 3 kids and they can give $34,000 each, that's $102,000 that we could shift out of our name, still keep in the family and have a say as far as how that asset is being used. But that $100,000 in that example does not count towards our lifetime exemption. And once the year passes, we don't get the opportunity to use it again. So how do we manage estate taxes without selling the family farm? This is maybe the most common question we get from farmers, which is, hey, my farm, let's say the exemption is 26 million, which obviously is a tremendous number these days for a married couple, but my farm and all my land is worth 30 million. So I leave 30 million down. That means 4 million of it. $4 million is open to estate taxes, which start at 40%, by the way, a 40% opening tax bracket. Well, 40% of $4 million is almost $2 million, right? It's over $1.5 million. Well, it doesn't necessarily mean that just because we have a $30 million farm that we have $1.5 million in cash setting aside that we can give to the Internal Revenue Service right when we die. So what do folks end up having to do? They have to sell part of the farm. It's really sad. They have to sell part of the farm to come up with the money to pay the tax on the farm itself. So we're going to utilize oftentimes the annual gift tax exemption to fund an ILIT. Maybe I've heard that term, ILIT. It's an irrevocable life insurance trust, and we're going to consult our estate planning attorneys that we have on our team and our CPAs that we have on our team to help fund these appropriately so that we can leave tax-free money so that we have cash available to pay the Internal Revenue Service, no matter where the estate tax exemption goes, without having to sell the farm that maybe has been in our family for generations. But how about another scenario? What if we want to fairly and equally divide a non-liquid asset like land among multiple beneficiaries? How often does this example happen? Somebody has 3 kids. Well, only one wants to take over the family farm, right? The other one's a fashion designer in New York City, and the other one is an aspiring amateur golfer. Well, we still want to take care of our 3 kids the same, but all of our assets are in this one piece of land, right? It's in this one farm, and only one kid wants to take it over. So we have a lot of strategies to equally inherit each of our children without having to sell 2/3 of the family farm or 2/3 of the land that maybe we want to continue to own as an asset, while still taking care of the 2 kids who want nothing to do with the land, want nothing to do with farming. It's a greater discussion for another day. We just don't really have too much time to get into the nitty-gritty details on that. There's the example that I had just given, but we're really just going to open this up for some questions, either for myself or Howard or really anybody. But if there's any of these pieces that you want to connect with us and we want to jump on a quick Zoom call and share some ideas that we may have for folks, it's important that if you have a financial advisor, that you consult them. If you have some counsel like an estate planning attorney or a CPA, that you consult them. And if you don't, we have all those folks on our team that we can be a resource. But shoot a quick text to our phone number to get in touch with Hannah and I right there, 219-851-2185. We're also going to send our information out. Just send us your name, and if you want to have a quick visit with us over Zoom, we're happy to do it. And if that's all super, and if we wanted to meet again after that, even better. But shoot us an email, shoot us a text, or give us a call, and we're happy to connect with you and actually get into your specific situation if we could be helpful for you. Howard, I think that's all I've got there.
Well, Lucas, I was just doing the math, $15,000 an acre, which is not an unheard of number in Indiana for some of the better farmland today. If I own 1,700 acres, I'm at $26 million.
Hmm.
There are a lot of farm operations that own 1,700 acres.
Right.
And the key is there's probably multiple family members involved in that farm operation at that point. And there are ways to divide that up so that not one person has their name on all of it and triggers the estate tax, or a couple does. In this case, 26 million would require a couple. But to your point, if the estate tax exemption goes to $10 million, then all of a sudden you've cut the amount of land to get to 10 million. Well, really 1,000 acres at $10,000 an acre does it. That becomes real. And there are a lot of land owners, both absentee landowners, our clients, and farmers, that $10 million, when you start to put equipment, livestock, farmland, homes, and the other assets, they're going to trigger that. And so really the value we thought in bringing Modern Woodmen, and you've got a whole host of resources around the country to access for this. You can't call Lucas, I'm guessing, don't call Lucas on October 21st, 2025 and say, hey, I got to do something by the end of the year. Am I correct in that? What kind of planning window does somebody need?
Look, the more the better. We need to be proactive, right? There's only so much we can do reactively. The same situation comes up every year on April 14th, right? Someone's filing their personal taxes and they find out they need more tax deductions. And well, look, there's just not much we can do a day before. But honestly, having at least, we don't know when somebody's going to die, right?
Correct.
If we can have a 5 to 10 year window before somebody dies, things are super kosher. But the reality is we never know when that day is going to come, right? And the only estate tax exemption that matters is the one that's in place when you die, especially if we haven't been proactively planning. So highly unlikely that the estate tax exemption goes up from here, much more likely that it goes down. But I think it's appropriate to plan as if it's going to be much lower. And if it ends up being higher, happy days, right?
And I think you made a really excellent point on the gifting, the annual gifting, because I've seen a lot of families use that over time, where they could give $34,000 to each kid, and they say, well, okay, we own the farm, 1,000 acres, we want to start gifting that. If we got 3 kids, all of a sudden you're up to about $100,000 a year. Right. You could start gifting, and yet they can retain all the income and all the control, right, Lucas?
Yes.
And
absolutely. So give the money away if you're going to give it to them later anyways, right? If you've already designated, hey, I've got all this money, I know who it's going to go to one day. Just don't wait until that day. Consult somebody like ourselves who understands how the process works. Give it to them now in an appropriate fashion. And yeah, over the course of 10 years, if you have 3 kids, you could easily gift $1 million, which at a 40% estate tax limit, you just saved yourself $400. Let me rephrase this. You saved your kids $400,000.
Right. And maybe they keep the farm.
Now they don't have to sell any acreage to produce that money. Yeah.
So we got a question from Bill. Multiple families own farmland. Now some want to pull money out of the farm and apply elsewhere while others stay in ownership. Do exiting owners have to expect a discount on the sale? That's a great question. We have, and you would probably expect, we have a lot of farmland owners, and sometimes they do have internal sales. If it's a corporation, and I can think of some specific examples where we've got a corporation that owns the farm, and they one minority owner wants to sell. It is easy, and Lucas, you can probably confirm this, but the IRS would readily accept a 33% discount for minority ownership. Am I correct on that?
Absolutely, yes.
And so one could argue, the other family owners who want to continue to own might say, well, I'm going to discount your ownership 33% to buy you out. It's a negotiable item when you're talking about one family member selling to another family member. So to answer the question, Bill, no, I don't think they have to expect a discount. But really it goes back to, and I've heard this argued by a lot of attorneys over the years, how do you own the land? Is it in a vehicle like an LLC or some other kind of ownership entity? And what are the buy-sell rules in that entity? And that really becomes pretty darn important when you talk about this kind of question. What are the buy-sell rules? How are they triggered? And what's fair? So I think no is the answer to your question in a real simple case. You don't have to expect a discount. Reality is, though, one person wants out. What is the LLC agreement? What is the trust agreement? What do those say about the ability to get out, and how is it offered to the other owners, and how is it appraised, and all of that? That's something I would like to think that the patriarch, the original owner who has set this up, has probably contemplated that and probably structured something that would be fair to everyone. Any other questions? Please enter them into the chat if you have any. And we are at 1 o'clock. We don't want to tie people up. So Jeff, you ask, what is the flex point for corn and soybean values for 23? And is that flex point used for all clients? I assume you mean the base gross revenue number. That means, quick explanation there. Let's say it's $1,000 an acre for corn. And Jeff, on my slide, I think I had between 650 and 1,050. It's a negotiable item, so it's a big range. But let's assume for 2023, I think 900 might be that average for corn. Soybeans, probably 700, 750, somewhere in there. And so those of you that don't understand our flex leases, we have a guaranteed rent. Let's say that's $300 an acre, 150 in the spring, 150 in the fall. That's paid regardless of what kind of year it is. And then if gross revenue on the farm goes above this flex point, or the base gross revenue number, so let's assume 900 for corn, then a share of that is paid to the landowner as a bonus. Usually our shares are 25% or 33%, maybe 50%. Again, those are negotiable. You need to talk to your representative about how to negotiate that. But Jeff, to answer your point, I think 900 on corn. What that means is if the corn price averages 550 and we produce 200 bushel, that's what, $1,100 an acre. That would be $200 an acre of profit over the 900 flex point. And if the landowner gets 25% of that, that's another $50 an acre on top of the base cash rent. So kind of like Lucas said, there are a lot of details to this, a lot of different ways that we do our flex leases. But to answer your question, Jeff, I'd say 900 on corn and probably that 700, 750 on soybeans for 2023. And as I just said, it's not used for all clients. We don't have one answer for all farms. And in fact, sometimes our farms use exactly what the farmer, what his cost of production numbers are. Others, it's a negotiated item. Good question. Any others? All right, well, we thank you for joining us today. I know I've already sent the slides. Joe sent some, Modern Woodman, and I sent my slides to Debbie Rapp. If you would like copies of those or a copy of this recording, reach out to Debbie or to me or to Lucas and Hannah, and we'll be glad to share those with you. So thank you all today. We are on the cusp of planting season here in the Midwest. We pray for safety as our farmers go to the fields. Hopefully good soil conditions and warmer weather. That's kind of predicted here for the next week. So looking forward to less storms, more calm weather, and a great planting season. And looking forward to a great 2023 cropland season. Thank you all for joining us, and we'll be back in July with another one of these, and hopefully have a different topic for you. I think we're looking at something about how to use an IRA to buy farmland. That could be interesting to some folks, in addition to our update on farmland values at that point. So thank you for joining us, and have a great spring. Bye, everybody.